Okay folks, welcome back. This is part 3 of a continuing series of 4 videos. If I could go back and tell myself what I know now. Again, this is a hypothetical conversation with my younger self. Purely fiction, just to give you a perspective on if I could tell myself what to focus on when I first started, it would hopefully have avoided majority of the painful lessons and losses that I had to incur. How would I practice? Where do you backtest daily setups? Now, before I get into this, this whole series is really linked to the optimal trade entry pattern that I've made public on my YouTube channel. I've also included 20 videos of daily setups, so that way it kind of gives you familiarity to what this pattern looks like across a wide array of different asset classes. But I'm covering a simplistic approach to how you should be practicing. First and foremost, everyone knows broker demo platforms. Okay, so whenever you open up an account with a broker, generally they offer you a trial version of their platform so you can test your strategies or whatever it is that you're utilizing for your framework for your setups. You can test drive it on a demo account. Forex has the ability to offer demo accounts that for some brokers don't expire, and it's not a big deal if it does expire. You can just start another one, but you don't want to treat the demo account like monopoly money. You want to sit down with it and say, okay, how much of this hypothetical pretend money would I be utilizing if I was trading? It wouldn't have been $50,000 to start with. And working with a demo with a sober mind about what you're doing and building good habits and removing the opportunity to fall into bad habits. That means overtrading, looking for setups, even after you've made a correct decision and the market shows you that you would have been profitable. It's not an invitation to go right back in the same day to try to get something else because it felt good. You're going to fall victim to that early on. So to avoid all that, don't have it in your mindset that you have to take a lot of trades every single day. You're going to lose a lot of money. You don't know it yet, but you're going to lose a lot of money trying to do that. And third-party apps like Forex Tester, and you can go to forextester.com, and they have a medium where you can go back and backtest strategies and such. And then finally, tradingview.com today, which doesn't exist at the time of you coming up now, Michael. The tradingview.com website offers pretty much everything that was available when you started. Metastock, Supercharts, TradeStation, all those things and bells and whistles that you're liking right now aren't really that important. You're going to focus primarily on the open, the high, the low, and the close. It doesn't feel like that's where you're going to be heading, but eventually you're going to strip all the indicators off your chart, Michael, and you're not even going to consider any of it. It doesn't make sense to you right now, but trust me, everything becomes clearer by not having anything on your charts. You don't have to have any overlays of your platform indicators. You like stochastic right now. It's not going to ever appear on your chart anymore. You like MACD. It's never going to appear on your chart anymore, Michael. You want to strip the chart down and focus on the 4 price levels that is the most paramount. It's the open, the high, the low, and the close, and looking at different intervals. The previous day's highs and lows, previous week's highs and lows, and previous month's highs and lows will offer a plethora of setups. It doesn't feel like that makes sense to you right now, but it will absolutely unlock all of the understanding that you'll need to carve out consistent, steady setups. So let's go into TradingView and look at how we can practice. All right, so here is the TradingView platform, and I have the chart set up with the euro-dollar currency pair. On the left-hand side, it is a 15-minute time frame, and on the right-hand side, it's a daily chart. And the assumption is that we're focusing on the optimal trade entry on a higher time frame until it delivers to a key level. And I'm going to show you right now what that would look like. Here we have a high that would be targeted. In here, as the price was rallying up, we can see before we got to this high, back testing these types of setups is what you would be doing. We're going to show a Fibonacci on this swing low with this candle's higher low and this candle's higher low surrounding this one particular candle. That's why I'm anchoring it to that. And I'm dragging it all the way up to this candle's high, because as it's making higher highs, I'm going to overlay the fib on every successive higher high, because that's going to be the range in which any retracement comes. It'll be within that range, and it'll be apparent when you see it here. So we draw this up to that. Okay, so you can see the Fibonacci that's anchored from this low up to this high. It captures this retracement. Now this candle right here is the 10th of July 2020. Here's the 10th on the 15-minute time frame. You can see how the 15-minute time frame drops down into the optimal trade entry, which is the 62 to 79% retracement level and 70.5 sweet spot. This level is going to be one of the levels you're going to like a lot, but you'll save yourself a lot of frustration if you just use the 62% retracement level, Michael. Most of the trades that you're hunting in these next couple of years are going to be unwilling to trade at a 70.5 or even 79% retracement level. But if you would just simply use the 62% retracement level and defer the insatiable desire for you to find the perfect entry all the time, later on in your 40s, you're going to feel real comfortable with not having the absolute best entry and the absolute best exit. There's lots and lots of opportunity in between. So 62% retracement level in here is ideal, and we can actually see a key reaction off of that 62% retracement level. Price starts to move higher. Now, your focus is to imagine every daily candle moving higher. Open near the low of the day, close near the high of the day, up close is the mode of delivery we're expecting until we get to this high. So when we get up to it and through it, okay, remember that slogan, to it and through it, to it and through it. That's how you're going to find the easiest bread and butter setups there is in every market asset class. The idea is the framework is this optimal trade entry is going to keep delivering until we get to this high and slightly above it. Here is 1/2 a standard deviation, and it's calling for 114.46 and 2 pipettes. Okay, the actual high of this price swing as of the time of this discussion, the high comes in at 114.52 and 1 pipette. So it goes just a little bit above that, but that's a good idea as a target, if not just simply at the old high. Now, we're going to take our concentration away from the daily chart because we can clearly see with the benefit of hindsight here that we had a series of up-close candles, and each day you'd be hunting a New York setup. Now, this is going to be the easiest framework, Michael, if you just submit to it early on. Stop trying to find trades outside of this time frame. Focus in here, and you're going to find everything that you would ever need. So all of our attention is going to go over to this chart here. So scrubbing forward a little bit, you can see the daily dividers. And what you're going to do is you're going to take a line segment. You can use the rectangle if you want. And you're going to delineate on the chart each day 8:30 to 11 o'clock in the morning New York time. So when you study this time, you're going to be able to see a retracement lower, because remember, the framework is every day the daily candles are going to go higher. That is what you'll later dub as the power 3. This high is going to be attacked, but each day is going to be accumulation, manipulation, and distribution. The accumulation is going to be near the low of the day. They're accumulating long positions. You're going to see that movement up going into New York. New York session is 8:30 to 11 o'clock. And as the market retraces lower in there, inside that consolidation and retracement, you're going to find a 5-minute optimal trade entry. That means a low, a swing high, down in that doesn't take out the previous swing low, trades to the 62% retracement level. Your stop would be below the low that creates the optimal trade entry. You would go long at 62 plus spread and reach for a previous day's high, or a combination of that and the standard deviations on the Fibonacci. That being, like, this is one standard deviation, this is one half a standard deviation, and so on. So each day you can start to see and backtest how many pips that using the 62% retracement level would give you, plus the spread for your entry that you would have risked to get that trade on, and how many pips it delivered. How long the trade took from entry to delivery to your target. How much of a drawdown did each setup take? You want to consider that, because if you have a large sample set of data, not every trade is going to start and turn right at the 62% retracement level. You might have to incur some drawdown. And don't make a big deal of it, Michael, because you're going to have a lot of trades, and they're not always going to be reacting as soon as you get in. Many times, the fact that they don't react right away is indicative of you being offside, and it's probably better for you to just kill the trade altogether. But that's another lesson another time. The next day, again, 8:30 to 11, you're going to look for the price structure that London creates a run, and then a retracement down into between 8:30 and 11. There's your optimal trade entry. And when you see that, again, 62% retracement level, aiming for a previous day's high. Previous day's high is here. So you're going to aim for a run through that, and then add your standard deviations on your Fibonacci tool for targets. Same premise. How long did it take you to get to profitability and cover the dealer spread? How many pips did you incur in drawdown? How much time did it take to get to target? All of that is building up a sample set of backlogs. This backlog is what you go back through and study for a hindsight derived experience. And by doing this, it will program your expectations to not perfect, but it will also show, like we're showing here, an instance where an optimal trade entry doesn't really necessarily form. And even if you use this one and down in, getting in long, your stop below this would have been tagged, so you would have a loss. So how much time did you take before getting stopped out? How many pips did it move against you from your initial entry, and how it traded for the day? All of these ideas give you, again, perspective. If you would have held on to this trade and didn't use a stop loss, or kept moving your stop loss down, as you will have done because you've made those mistakes early on already, and you're going to make those mistakes for another year and a half, because you're going to wrestle with the idea of being right. It's not about being right, Michael. It's about being consistent and flexible. When you can see the signals that are indicating that you're wrong or offside, you have to kill it. Don't arm wrestle it. There's so many opportunities. If you try to blow your account on one particular trading day because you can't accept the fact that you were wrong, you can't accept that you're human, then you're going to struggle more than you have to. And that's why I'm talking to you right now. I don't want you to go through all that, because at 47, turning 48 soon, these problems that you're going to encounter if you don't listen to me are still going to be painful to relive or remember. How much information do you use from this bad example in terms of profitability, but good example for learning? You don't want to torture yourself and say, well, I was stupid because it was really screaming against me, or I should have saw these multiple attempts to go higher and then break down. I just picked a really bad trade and I was foolish for doing it. Don't do those types of things, Michael. Don't fill your journal up with toxic thinking. You're going to fill up the first 3 years of journals with a lot of things that are going to be linked to your subconscious. And you're going to look at the markets and you're going to remember, man, this looks like that time I lost X amount of money and didn't use a stop, or I didn't get out when I should have gotten out. And you're reliving all those painful moments that you journaled. You're going to use your journal to have positive, constructive Not negative criticism, but positive criticisms. It's important for you to frame your annotations in your journal in such a way that there's no emotions whatsoever. None. But you still want to pull out the information that's salient to the lesson, because when you're wrong, you need to study what led to you being wrong. So that way, eventually, you're going to key up on the things that you're doing that are problematic and you're falling victim to over and over again. But until you study them with a sober mind and objectively, you're going to keep falling victim to it, and you're not going to understand why it's happening. Not only will you lose a lot of money, but you're going to have a lot of frustration that's completely avoidable if you just do what I just gave you right now. The next day, same thing. We're not looking for every single day to be a winner. We're expecting it's going to be a trade that may not pan out. But we're staying with the same narrative. We're looking for, this day here is the 16th, and that is on the daily right here. That's this day here. Now that's a down close candle. When you see this, okay, you're going to see this high, and the next candle has a lower high. That swing high is going to make you think early on that it's creating a top, and there's no more buy signals to take. Don't believe that. Just because it's making a swing high doesn't mean it's not going to likely give you another buying opportunity. Even on that particular day, it gives us an optimal trade entry here. And you want to study again, 62% trace on level. How much time did it take to cover the dealing spread and move to target? How many pips did it offer? And even though it didn't get to the previous day's high, by taking out scaled profits, you don't have to be right about the next trade running to the previous day's high when you're bullish. Short-term highs in here, as it runs up, you want to take profits off there. And when you backtest and practice, you would be doing the same thing, assuming that if you were in a trade, you would take something off here, and you would take something off here, and as it goes up into this area over here, you may have been expecting it to trade above here, but in this case, it turns around. How much time did you stay in the trade while it was dropping down here? How long would you expect to hold on to that trade before you realized that you were wrong? And be honest about it, because what you pour into your back testing and practicing, while it's hindsight, if you are not honest with yourself, if you put in poor expectations, you're going to get ridiculously backwards results. You're going to expect certain things that aren't realistic to see in terms of outcome, and you're going to be at the mercy of your emotions, and you're going to be pulled around by a psychological tug of war about being right or wrong if you don't do these things. So the next day, even though we had a losing day here in this trade, while it was profitable, it didn't deliver to the previous day's high. It's fine. You stick with the narrative. Next trading day, here it is, 8:30 to 11, optimal trade entry. It's dropping down, and it gives us two opportunities. It drops into it here, and it gives us another one here, and then takes out the previous day's high here. So we have now delivered a setup that takes out the previous day's high, and this is Friday, so you can't trade the next day. It's a Saturday. But how many pips did it take from entry to scaling at your previous day's high? How many pips was that? How much time did it take? How many pips did you have in drawdown? All of those ideas you build a backlog of. And then on the weekends, you want to study how each one of these work together to complement one another. In other words, how did the previous day's trading set up the situation that you saw on the next day? And look at it from a hourly perspective, a daily perspective, and it'll help you frame out the institutional order flow that you'll become known for in the Forex division. So in this case, following this criteria and practicing every single day, just keeping a backlog of it, you're going to not only train yourself to see the setup, but you're going to grow in your understanding about how the characteristics repeat over and over and over again, and staying with just one currency, but framing all the ideas on a higher time frame basis that leads to high consistency without having to need perfection. So I hope you have found this one insightful. I will be back again next week with the final portion of the series, how to transition into practice into live funds. Until then, I wish good luck and good trading.